Later this month, copper producers, consumers and traders will meet in London to hammer out annual supply deals for next year. As usual, they will have different ideas about what the physical premiums attached to those contracts should be. As they ask for higher premiums, copper producers will point to low LME warehouse stocks, expectations of further growth in China, and the usual mine-side supply slippage that has come to plague the copper industry in recent years. Consumers, for their part, will offer their own data-driven counter-argument. They will say that copper miners are expected to produce more next year and consumers will need less. They will also point to the large volumes of stock that have built up in Shanghai warehouses as evidence of the fact that consumers in China overbooked on contracts for this year, and they are not expected to be so aggressive in buying this time around, particularly considering that copper prices today are around 20% higher than they were a year ago. Ahead of the negotiations, Metal Bulletin has conducted a straw poll of consumers, traders, producers and analysts, and the results indicate that consumers may be able to table the more persuasive arguments this year. There are expectations that the Asian benchmark set by Codelco at $110 per tonne will fall. As one analyst in Hong Kong put it, the European premium at $90 already looks a bit punchy for the Asian market, where spot premiums are currently running at around $50. That analyst expects that the overall volume of business booked on contracts next year by Chinese consumers could fall by as much as 50,000 tonnes per month, as they show a preference for the spot market. That, incidentally, is exactly what European consumers have done this year. As a result, their sporadic spot buying has helped to lift premiums from $50 per tonne at the start of the year to $100 today. There are expectations that they will continue to pursue this just-in-time strategy, and as a result, spot premiums should remain elevated next year. There are also expectations that the Asian market may follow the lead of the European market next year. As a result, benchmark premiums may fall and spot premiums may rise.